With 25% U.S. tariffs now confirmed for Canadian products, there are no talks of boycotting U.S. products.
In 2025, the trade war between the United States and Canada escalated sharply after the United States imposed 25% tariffs on Canadian goods, including energy, agriculture, and consumer products. These tariffs were not merely economic measures. They were perceived as a political slight, coming on the heels of statements by former President Donald Trump claiming that Canada could be treated as the 51st state of the United States. The statement sparked outrage among Canadian citizens who felt ignored, insulted, and disrespected by their closest neighbor. Across Quebec, Ontario, and other provinces, shoppers responded immediately. According to a national survey conducted by the Angus Reid Institute in February 2025, 98% of Canadians now actively look for Made in Canada labels when shopping. 48% have replaced as many American products as possible with Canadian alternatives, while 37% switched to Canadian items when quality and price allow. In total, approximately 85% of Canadians have modified their purchasing habits to boycott American products, at least partially. This consumer backlash is not limited to grocery stores. Canadian travelers have canceled trips to the United States, and cross-border shopping has plummeted. Retailers are adapting quickly. Grocery chains and specialty stores across Canada have removed U.S. made products from shelves and introduced prominent Made in Canada signage to help consumers support domestic industries. Experts warn that the boycott will only have a lasting impact if Canadians commit to long-term changes in purchasing behavior. The question remains, can a nationwide consumer movement reshape trade patterns, force the United States to rethink tariffs, and alter North American commerce forever? The next part will reveal the dramatic numbers showing how steeply American exports to Canada have fallen and why this is more than a temporary disruption. The economic shockwaves are staggering. Between March 1st and April 30th, 2025, American exports to Canada plummeted across multiple sectors. U.S. Spirit sales fell by 66.3% nationwide, with some provinces, such as Ontario, experiencing declines of 80%. Overall, imports of American consumer goods dropped by approximately 12.8%. Grocery shelves across Canada were cleared of U.S. made snacks, beverages, and household items, while Canadian alternatives surged in visibility and demand. Retailers reported stock shortages for popular domestic brands as consumers rapidly shifted preferences. Energy markets were not spared. Refined gasoline imported from the United States, previously sourced from Alberta, crude processed across the border, faced scrutiny and partial replacement with domestic blends. Analysts warned that the disruption of supply chains will ripple into the summer, affecting pricing, availability, and industrial production. The political dimension deepens the crisis. Public sentiment toward the United States has turned sharply negative, fueled by the perception of economic aggression and dismissive rhetoric labeling Canada as the 51st state. Experts note that the combination of tariffs, public outrage, and consumer boycotts has the potential to trigger permanent shifts in trade patterns. And the most shocking twist, data indicates that entire segments of U.S. exports may vanish from Canadian markets by the end of the year, with consequences far beyond the grocery aisle. The backlash against American products in Canada reached a critical peak in the spirit sector. Beginning March 5, 2025, major Canadian provinces, including Ontario, British Columbia, and Quebec, removed nearly all American-made spirits from retail shelves. The immediate effect was catastrophic for U.S. exporters. Nationwide, American spirits sales fell by 66.3% over the two-month period ending April 30th, with Ontario alone experiencing an 80% decline. Whiskey brands such as Jack Daniel's and Jim Beam faced unprecedented market loss, and smaller distillers reported halted shipments and canceled contracts. Overall, total U.S. spirits exports to Canada dropped below $10 million U.S. dollars, representing an 85% contraction compared with the same period in 2024. Wine exports were not immune. Sales of American wine plunged 67%, compounding the crisis. This economic shock extended beyond the spirits industry. Retailers reported widespread stock shortages of domestic alternatives as Canadian consumers sought products with Made in Canada labels. According to the Angus Reid Institute, 98% of Canadians surveyed actively sought domestic alternatives when possible, and approximately 48% replaced all American products in their shopping carts. 37% made selective substitutions where quality and price were comparable. The cumulative effect of these behavioral shifts was a sharp decline in revenue for American exporters and increased demand for Canadian producers, forcing domestic suppliers to scramble to meet the sudden surge. The energy sector was equally affected. Refined gasoline, previously imported from the United States, processed from crude oil sourced in Alberta, saw partial substitution with domestic blends. Analysts predict that continued supply disruptions could increase fuel costs for Canadian consumers by up to 5% over the next quarter. Industrial sectors dependent on integrated U.S. Canada supply chains, such as auto manufacturing and aluminum production, also reported early signs of strain, with production delays and increased operational costs. The political dimension amplifies the economic turmoil. Public sentiment toward the United States has deteriorated sharply, fueled by American tariffs and perceived dismissive rhetoric labeling Canada as the 51st state. Government and industry officials warn that the boycott is no longer a temporary reaction, but a coordinated consumer movement with long-term implications. Business groups estimate that the combined impact on U.S. exporters could cost tens of thousands of jobs and billions of U.S. dollars in lost revenue if the boycott persists through the end of 2025. Beyond economics, the boycott has heightened nationalistic sentiment in Canada, reinforcing public and corporate support for domestic industries. Retailers, associations, and local producers have collaborated to improve product visibility, promote Canadian branding, and encourage long-term loyalty. Experts suggest that if Canadians maintain their commitment, the disruption could permanently rewire trade flows, reducing U.S. market share and establishing a new equilibrium in North American commerce. The most startling development is yet to unfold. Preliminary projections indicate that additional sectors, including packaged foods, consumer electronics, and household staples, could face similar declines, potentially eliminating entire categories of U.S. exports from Canadian shelves by the end of the year. The next section will reveal how these disruptions are cascading into broader North American trade patterns and why the United States may face an unprecedented strategic challenge. The economic fallout of the Canadian boycott extends far beyond grocery aisles and liquor shelves. By mid-2025, U.S. exports to Canada had shrunk dramatically, with total American shipments accounting for only 68% of Canada's total imports, a decline of 10 percentage points compared with the same period in 2024. This contraction affected not only consumer goods, but also industrial materials, agricultural products, and energy commodities. Analysts note that American exporters are confronting losses amounting to billions of U.S. dollars, with key sectors such as spirits, packaged foods, and electronics experiencing near total revenue collapse in Canadian markets. In response, Canada is aggressively diversifying its trade portfolio. Exports of commodities including gold, uranium, petroleum, and pharmaceuticals are increasingly directed toward Europe, Asia, and Australia. Industry reports indicate that Canadian companies have signed at least 50 new trade agreements with non-U.S. partners in the first half of 2025, expanding markets that were previously dominated by the United States. Economists suggest that this diversification is not temporary. It represents a strategic pivot aimed at reducing Canada's economic dependence on the United States while bolstering domestic industries. Retailers across Canada are increasingly prioritizing domestic sourcing, with 45% of grocery chains reporting a significant increase in local product visibility and sales compared with the previous year. Consumer behavior reinforces these structural changes. Surveys show that 85% of Canadians have permanently adjusted purchasing habits to favor domestic products. Cross-border shopping has declined by approximately 30%, while travel to the United States has dropped sharply, especially for non-essential trips. These changes are causing tangible reductions in American tourism revenues and altering the flow of North American commerce. The boycott and associated tariffs are causing ripple effects through integrated supply chains. Industries dependent on North American interconnectivity, including automotive, aluminum, and energy production face operational disruption. Reports indicate that auto parts shipments from the United States to Canada fell by 15% in the first quarter of 2025, leading to delayed production schedules and increased manufacturing costs. Aluminum and steel imports are similarly constrained, affecting construction and industrial projects across Canadian provinces. Energy supply is also under pressure. Refined gasoline imported from the United States, previously processed from Alberta crude, has been partially replaced with domestic blends. Analysts warned that this substitution could increase fuel prices for Canadian consumers by up to 5% over the summer months. The broader industrial strain demonstrates that the boycott is not a temporary inconvenience. It has become a systemic challenge affecting production, pricing, and employment across multiple sectors. Politically, the tensions are escalating. Canadian public sentiment toward the United States has grown sharply negative due to the combination of tariffs, the 51st state rhetoric, and perceived dismissive policies. Policy advisors warn that if these trade patterns persist, the United States could lose long-term influence over Canadian markets, forcing Washington to reassess its strategic and economic approaches in North America. In the next section, we will explore how these disruptions are reshaping the United States' economic landscape and threatening long-standing industries in ways few Americans expected. The American economy is already feeling the strain. U.S. exporters in key sectors, including distilled spirits, agriculture, and consumer goods, have experienced precipitous declines in revenue. U.S. spirits exports to Canada dropped 85% by the second quarter of 2025, falling below $10 million U.S. dollars. Wine exports fell 67%, while packaged foods, snacks, and beverages have seen similar contraction. Industry estimates suggest that tens of thousands of American jobs are at risk if the boycott persists, particularly in states heavily reliant on cross-border sales such as New York, Michigan, and Washington. Small and medium-sized businesses face the greatest vulnerability. Many companies report halted shipments, canceled contracts, and logistical challenges as Canadian retailers increasingly prioritize domestic alternatives. Analysts warn that continued trade friction may force American firms to reallocate resources, delay hiring, or even exit the Canadian market entirely. These shifts represent not just lost revenue, but potential long-term erosion of U.S. influence in one of its largest trading partners. The combined effect of tariffs, political rhetoric, and consumer backlash threatens to amplify these risks. With cross-border shopping down by nearly 30% and tourism from Canada sharply declining, revenue losses extend beyond direct exports to the broader service and retail sectors. Economists caution that the ripple effects could depress regional economies and reduce tax revenues in border states. Beyond immediate economic losses, the United States faces strategic challenges that may reshape North American trade. Canada's diversification into European, Asian, and Australian markets reduces its reliance on the United States, potentially weakening Washington's leverage in future negotiations. Preliminary data indicates Canadian companies have signed over 50 new trade agreements in 2025 alone, redirecting billions of U.S. dollars in exports to other regions. The political implications are equally severe. Public sentiment in Canada has turned sharply negative, fueled by both tariffs and the perception of dismissive American rhetoric, including claims that Canada could be treated as the 51st state. This sentiment is likely to influence policy and consumer behavior for years, creating a long-term obstacle for American exporters. Supply chain disruptions, particularly in the automotive, aluminum, steel, and energy sectors, further complicate the situation, with delays and cost increases projected to continue into the next fiscal year. Trade analysts warn that if these trends persist, the United States could lose significant market share, while Canadian domestic industries solidify their position and expand globally. The potential collapse of entire sectors of U.S. exports from consumer goods to industrial components may force policymakers in Washington to reconsider tariffs, renegotiate trade agreements, or implement emergency measures to protect domestic industries. The next section will examine Canada's long-term strategy, how it may consolidate gains, strengthen domestic industries, and turn the tables on the United States in ways few anticipated. The ongoing boycott and trade tension provide Canada with a unique opportunity to restructure its economy and reduce reliance on the United States. Canadian policymakers and industry leaders are accelerating efforts to diversify export markets, targeting Europe, Asia, and Australia. Preliminary data from 2025 indicates that Canadian companies have signed more than 50 new trade agreements, collectively worth billions of US dollars. These agreements include key sectors such as energy, agriculture, pharmaceuticals, and manufactured goods. Retailers across Canada are supporting domestic brands aggressively, increasing shelf space and marketing campaigns for made-in-Canada products. According to reports, 45% of Canadian grocery chains now prominently feature domestic goods over US-made alternatives, driving higher consumer engagement and sales. Surveys show that 85% of Canadians have permanently adjusted purchasing habits to favor domestic products, reinforcing the long-term potential impact of the boycott. Experts argue that sustained consumer commitment, combined with government support, could allow Canada to consolidate gains, strengthen local industries, and establish long-term global trade relationships independent of the United States. The economic logic is clear. The longer Canadians maintain this purchasing behavior, the greater the potential to permanently alter trade flows and reduce American influence. For the United States, the long-term consequences of the Canadian boycott and trade war are severe. Immediate losses in sectors such as distilled spirits, consumer goods, energy, and automotive components are only the beginning. Analysts project that if the boycott persists through the end of 2025, U.S. exporters could forfeit tens of thousands of jobs and lose billions of U.S. dollars in revenue. The political dimension amplifies the threat. Anti-American sentiment among Canadian consumers and policymakers is intensifying, particularly following former President Donald Trump's statement that Canada could be treated as the 51st state. This has eroded goodwill and may have lasting effects on consumer behavior, trade negotiations, and cross-border investment decisions. Supply chain disruptions also pose a significant risk. U.S. manufacturers reliant on Canadian intermediaries, raw materials, and components face increased costs, delays, and production challenges. Analysts warn that the combined effect could reshape North American industrial patterns, forcing U.S. companies to seek alternative suppliers, relocate production, or reduce operations. In short, the United States faces both an economic and strategic challenge. Whether to maintain tariffs and risk further market loss, or reverse policies and concede economic leverage to Canada. The consequences of either choice could reshape trade relations, consumer markets, and industrial integration across North America for years to come. The final part will summarize the stakes and ask the ultimate question: is this Canadian boycott a bold strategy for national sovereignty or a risky gamble with repercussions for the entire North American economy? The Canadian boycott of American goods, triggered by 25% U.S. tariffs and political rhetoric labeling Canada as the 51st state, has escalated into a full-scale economic and political crisis for the United States. From liquor shelves to grocery aisles, and from consumer goods to energy commodities, American exports have experienced steep declines. Distilled spirits fell 85% in the second quarter of 2025, wine dropped 67%, and packaged foods and household items reported losses exceeding 12%. These numbers illustrate more than a temporary disruption. They reveal a fundamental shift in trade behavior, driven by national pride, political outrage, and economic strategy. Canadian consumers are not simply reacting, they are reshaping the market. Surveys indicate that 85% of Canadians have permanently adjusted purchasing habits, actively seeking products with Made in Canada labels. Retailers and producers have responded, increasing domestic product visibility by 45%, while Canadian exporters have diversified markets, signing over 50 new trade agreements with Europe, Asia, and Australia. The structural pivot threatens to permanently reduce the United States' market share in its largest trading partner and force American industries to reevaluate supply chains, production locations, and market strategies. The stakes for the United States are profound. Tens of thousands of jobs are at risk. Billions of U.S. dollars in revenue are potentially lost. And integrated supply chains face disruption. Political tensions, heightened by former President Donald Trump's statements, have fueled long-term anti-American sentiment among Canadian consumers and policymakers. Analysts warned that the continuation of this trade war could fundamentally alter North American commerce, weaken U.S. influence, and empower Canadian sovereignty in the global marketplace. The ultimate question remains, is this Canadian boycott a bold assertion of national sovereignty and economic independence, or a risky gamble that could have unintended consequences for both countries? The answers will unfold over the coming months as tariffs, trade negotiations, and consumer behavior continue to shape the future of North American commerce.